Hi, welcome to Financial Profiles Vlog for September 1st, 2009. I'm Blake Desaulniers. Warren Buffett's observation that there are three types of people in an economy: innovators, imitators, and idiots, clearly reflects in the classic three phases or legs of a bull market. Since the start, 2009, we've seen Buffett's innovators move, with markets up 30% or more. Despite ubiquitous bad news, disastrous trailing indicators, and headlines announcing bankruptcies, bailouts, and mayhem in the financial markets, innovators made their move early, as usual, picking up stocks at bargain prices from those who wanted to or were forced to sell into a market characterized by fear. The innovators again demonstrated their ability to see past the short term and to filter the noise and establish early positions in key growth sectors. For instance, even while venture capital funding in clean technology deals withered in the first half of the year compared to the same period 12 months earlier, the clean tech index rose from below 600 to nearly 1,000, close to a 40% gain, a gain similar to or exceeding gains on most stock markets since early March. A 30 to 40% gain in 6 months on the stock markets looks pretty good by historical standards. In 2003, the Dow rose from around 8,000 to 10,500 in 10 months, a gain closer to 25% in the first leg of a new bull market, before consolidating for much of 2004. Following its initial run, the Dow slipped sideways for most of the year before starting on a longer, more stable climb from 10,000 to 12,000 by mid-2006 or early 2007, the second leg of the bull lasting around 18 to 24 months, depending on how you read the Dow chart. Buffett's imitators had arrived. News was good, trailing indicators turned positive, corporate earnings began rising, inflation remained under control, and in general, almost anybody could invest with confidence during this period, as very little evidence of risk appeared anywhere. The final leg of the 2003-2007 bull market occurred, as it often does, when the idiots piled in and drove stock prices up sharply and rapidly. By the summer of 2007, you could see the churn at the top. The Dow had moved from 8,000 in 2003 to 14,000 in 2007, with the last 2,000 points coming mainly in the first quarter of 2007. A rapid 20% rise coming off a bottom could make sense, but after two solid legs up, it could only have been Buffett's idiots who kept buying stocks aggressively or insisted on holding. Is stock market history repeating itself yet again? In 2009, we've already seen the first leg up, and a solid one it was, and we've begun to see consolidation ahead of trailing indicators turning positive, which is largely what the imitators will wait for. Lacking confidence, and in many cases resources, to step in at the pit of a recession where the real bargains can be found, imitators will appear on the scene once the potential for missing out on increasing corporate earnings and improving economic fundamentals and the appearance of widespread good news headlines compels them to get back into stocks. When this will happen can't be predicted with much accuracy. Perhaps 2010, perhaps 2011, but eventually the second leg of the bull market, likely lasting somewhere around 24 months, will get underway. I think there are three sectors that will turn imitators into innovators. Every bull market has its particular characteristics, and every investor has their own preferences. For those who watch trends and understand technology, and for those imitators who want to get the kind of returns innovators get, three sectors ought to have great appeal: clean tech, nanotech, and energy efficiency. Beyond merely the scope of this bull market, these emerging markets look to have extraordinary growth potential and are in many ways intertwined, both economically and technologically. Energy efficiency is a part of clean tech, for instance. Solar panels or wind turbines used to reduce the carbon footprint of a production process amounts to both energy and clean tech. If the surface had been developed using nanocrystals, it may also be a nano business. Yet each of these sectors will foster initiatives that qualify as pure play. Nano-based electronics, for instance, look to be on the verge of taking computing to the next level, as the current threshold of miniaturization has already come into view. Still, most people know very little about these sectors, perhaps more about energy and less about clean tech and nano. Yet as small cap investors, they ought to learn. In a larger sense, each of these three sectors offers the opportunity for anybody to make Buffett's Innovators class, which is to say that each of these sectors offers such excellent long-term potential, and that gains to date represent only a tiny tick on what is widely expected to be a spectacular secular uptrend. Of course, most imitators don't feel comfortable making their move until they see bottom line results getting fatter, a little late by innovator standards. Taking the characteristics of a short-term beginning of a bull market in stocks and extrapolating to an emerging sector, and in particular in microcap stocks, it's easy to see how an effort to understand nanotechnology, clean technology, or energy efficiency can and will pay off. In the context of the current bull market, it is clear that innovators are in. It is not, however, clear that the pole positions have been established in nanotech, clean tech, and energy efficiency for the long term. It is likely that the imitators will show up in the stock market pretty soon. For their sake, let's hope they find their way in some part to these sectors. Remember to join Financial Profiles for updates, reports, and special features at financialprofilesmedia.com. For Financial Profiles, I'm Blake Desaulniers. Thanks for watching.